There's plenty of chatter about if and when Ben Bernanke will start to raise interest rates. Our own Sheila Dharmarajan has been breaking down the data like only Bloomberg can, and she's at the touchscreen. Sheila, what do you have for us?
Well, Scarlett, what it comes down to is that over and over again, even including today, traders have been expecting a Fed rate hike in a couple of months, but they've been wrong. So, for example, even last December, Fed fund futures indicated a rate hike in 3 to 4 months. Fast forward that to 6 months ago. Again, rate hike in 3 to 4 months. 1 month ago, you can see, again, same trend here. And even today, traders are still expecting the Fed to hike rates in 3 to 4 months. But despite these market expectations, our analytics team has put together data why a rate hike could be at least a year away. Now, one metric to look at is GDP. So this is our factories, workers, and services, and whether these resources are being used to their fullest potential. So I want to show you a chart about potential GDP. Now you can see that the blue line here, which is potential GDP, now that's what happens if every single resource was being used to its fullest. And the green line is going to show actual GDP. Now that's what's actually being used now. Now you can see right now that there is a big gap between the two. And that's because the resources we have aren't being used to their fullest. So this is the largest gap that we've seen in 25 years, Scarlett. So again, another indication that a rate hike might not be coming that soon.
Well, with unemployment at 10%, the highest in decades, how does that play into what the Fed will do next?
You know, we've looked at that. And for example, when you start to track the Fed funds rate with unemployment for the past 10 years, let's take a look at what happened in the 1990 to 1991 recession. You can see that unemployment peaked. The Fed started to hike rates, but that was a 20-month lag it took before they started to hike those rates. Let's look a little bit more recently in 2003. Unemployment hit a peak. Fed started to hike rates. But that was a 13-month lag that it took before they started to hike those rates. Now, taking a look where we are now, even if you think we've reached a peak unemployment line, when you look at these Fed fund rates and the time they've taken to hike those rates, it indicates that we're probably not going to see another rate hike in about 12 months, Scarlett.
Right, at least a year. Now, what about inflation? That, of course, a factor as well. We've gotten the PPI and CPI numbers, which, at least on the wholesale level, could indicate prices are starting to rise a little bit.
Right, so we did get some better than expected CPI and PPI numbers. But I want to point out that those reports, they only measure prices for products and goods. And they ignore the primary spark for inflation, which is your take-home pay. So when you look at wages, you can see that the trend is dramatically different. Now, this shows year-on-year wage growth. And you can see we've certainly had declines in the past. But I want to show you where we are right now. What you can see is that the most recent wage declines is probably some of the steepest declines that we've seen in the past 20 years. So without money in your pocket to spend, it's going to be hard to sustain the gains that we saw in CPI and PPI, Scarlett.
All right, thank you so much, Sheila Dharmarajan, at our touchscreen.